What are commercial banks? Let us discuss in this video. A commercial bank is a financial institution that accepts deposits from the public and gives loans to individuals, businesses, and governments. Let us see the functions of commercial banks. The 6 primary functions of commercial banks are accepting deposits, granting loans, credit creation, providing agency services, offering utility services, and delivering modern banking services. Let us go through all functions one by one. Banks accept money from the public in different forms, such as savings account, current account, fixed deposit, recurring deposit. Let us go through one by one. Banks usually offer around 2% to 5% interest per year on savings account deposits, subject to certain conditions. They are: you must maintain minimum balance requirements, allows limited daily withdrawals. A current account is designed mainly for businessmen, traders, companies, and firms who make frequent transactions. For current account, no interest is usually paid on current account balances, allows unlimited deposits and withdrawals in a day. In fixed deposit, money is locked for a fixed period and earns higher interest than a savings account. The benefits of fixed deposit are higher interest rates, usually 5% to 9% per year, with tenure 7 days to 10 years. And also with one restriction: you cannot withdraw before maturity. Penalty applies. A recurring deposit allows a person to deposit a fixed amount every month for a specific period. The features are monthly fixed installment with tenure 6 months to 10 years. Interest rates similar to FD. Banks provide many types of loans, which are divided into 2 categories: secured loans and unsecured loans. Let us go through each one. A home loan or mortgage loan is money you borrow from a bank or financial institution to buy or build a house, by keeping house as collateral. You repay this amount monthly through EMIs, equated monthly installments. If you default loan, bank will take over your building. A personal loan is money you borrow from a bank without giving any security or collateral. It's based purely on your income, credit score, and repayment history. A vehicle loan is money you borrow from a bank to buy a car, bike, scooter, or commercial vehicle. The vehicle you buy becomes the security for the bank. A business loan is money borrowed from a bank to start, run, or expand a business. It can be used for stock, machinery, salaries, marketing, or business growth. Banks give funds and you repay it through EMIs or flexible payments, depending on the type of loan. Some business loans need collateral, while many small business loans are unsecured. An education loan is money borrowed from a bank to pay for college, university, or any higher education course. It covers tuition fees, books, hostel, travel, and other expenses. You don't have to repay immediately. You get a moratorium period, course duration plus 6 to 12 months. After that, you start repaying through EMIs. Cash credit is a short-term loan facility given to businesses to manage daily working capital needs like buying raw materials, paying salaries, or maintaining stock. It lets you withdraw money even if your account balance is low. The bank gives you a limit, for example $100,000. You can use any amount within this limit. Interest is charged only on the amount you actually use, not on the full limit. A credit card loan is money you borrow using your credit card. You can take a loan on your card limit or convert your big purchases into EMIs. Overdraft is similar to cash credit, but it is also given to salaried person. In overdraft, bank gives you an OD limit, for example $20,000. You can withdraw or transfer money anytime within this limit. Interest is charged only on the amount you actually use, not on the full limit. Commercial banks create money by giving loans to the public. Even though they receive only a small amount as deposits, they can create multiple times more credit using the fractional reserve system. Let us see step-by-step process of credit creation. Step 1. Customer deposits money in the bank. Step 2. Bank keeps a small part as reserve, example 10%. Step 3. Bank lends the remaining amount to another person. 4th. The borrower spends the money. 5th. That money becomes a deposit in the same or another bank. 6th. The new bank again keeps 10% reserve and lends out the remaining 90%. The chain continues, creating more and more credit. Confusing, right? Let us understand it through a scenario. There is a bank that needs credit from customers. A man named Ardi has $10,000 and wants to earn interest on it, so he decides to open a fixed deposit in that bank. So Ardi deposited his money in the bank for a fixed number of years in return for interest. Now, a woman named Kruthi needs a loan and wants to borrow money from that bank. The bank keeps 10% of the deposit as cash reserves, as required by the rules, and lends $9,000 to Kruthi. Kruthi spends the money on some goods she buys from a shop. The shopkeeper now has the $9,000, and he also wants to deposit it in the bank. The shopkeeper deposits the $9,000 as an FD in the bank. Again, the bank keeps 10% of this amount as reserves and gives the remaining as a loan to another person. And this cycle continues. Now let us see calculation part of credit creation for our example. Total credit created equals initial deposit times 1 over reserve ratio. Reserve ratio equals 10%, which in decimal form equals 0.10. Credit multiplier equals 1 divided by 0.10, which equals 10. So, total credit, $10,000 times 10 equals $100,000. Banks created $90,000 of new money, even though the original deposit was only $10,000. Banks act as agents for their customers. For example, they pay bills, collect checks, and manage clients' investments. In return, they charge a commission for these services. Under utility services, banks offer facilities such as ATMs, debit and credit cards, locker services, foreign exchange, and mobile internet banking, for which they charge certain fees. Finally, banks provide modern services such as online banking, e-wallets, QR payments, and AI-based services, for which they collect small service charges. This concludes the discussion on commercial banks. Thank you.